Warren Buffett, often called the Oracle of Omaha, has made a career out of keeping his cool when everyone else is losing theirs. But right now he's doing something that has investors nervous. He's selling, not just a few stocks here and there, but billions of dollars worth. This has led to articles like this being written. Does Warren Buffett know something Wall Street doesn't? The billionaire legend dumps $122 billion of this key holding while buying $4 billion of these out-of-favour stocks. Warren Buffett has never been afraid to go against the grain. He once summarised Berkshire Hathaway's investment strategy as, "We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful." That resulted in some very notable moves from the Oracle of Omaha over the last few years. As many large cap stocks have seen their valuations climb higher and higher amid unbounded investor optimism, Buffett has been a notable seller. In fact, he sold more stock than he bought for Berkshire Hathaway in each of the last 11 quarters. The most notable stock sale in that period is Apple, which at one point accounted for more than half of Berkshire's marketable equity portfolio. Buffett started selling the stock in late 2023, and he's since sold nearly 70% of Berkshire's stakes in the business. In total, those stock sales raised an estimated $122 billion in cash, based on the weighted average stock price. The actual sale price for each lot is unknown. In recent months, Buffett has sold over $4 billion in Apple shares, cut nearly half his position in Bank of America, and completely exited companies like T-Mobile and Charter Communications. For 11 straight quarters, that's almost 3 years, Buffett has been a net seller of stocks. And the result? Berkshire Hathaway, his company, is sitting on a record-breaking cash pile of $344 billion. That's more cash than Apple, Microsoft, and Nvidia combined. So what's going on? Why is the world's most famous investor, a man who usually buys when others panic, now holding back? According to Buffett's own statements and analysis, there are three main reasons behind his caution: extreme market valuations, skyrocketing US government debt, and a lack of attractive investment opportunities. Let's break down each of these and what they reveal about his outlook on the economy. 1. The stock market looks overpriced, even to Warren Buffett. Warren Buffett is famous for being a value investor. He likes buying great companies at fair prices, not overhyped companies at ridiculous ones. But right now, according to Buffett's favourite valuation metric, known as the Buffett indicator, the stock market is more expensive than it's been in decades. The Buffett indicator measures the total value of all publicly traded US stocks against the country's GDP. Basically, how big the market is compared to the economy itself. The Buffett indicator is a ratio comparing the total US stock market value to GDP, popularised by Warren Buffett after he used the metric to correctly predict the dot-com bubble burst in the late 1990s. In a 2001 interview with Fortune magazine, Buffett looked back at his prediction and explained how he knew stocks were about to plummet. For me, the message of that chart is this: if the percentage relationship falls to the 70% or 80% area, buying stocks is likely to work very well for you, he said. If the ratio approaches 200%, as it did in 1999 and a part of 2000, you are playing with fire. As of October 2025, the Buffett indicator ratio sits at around 220%. For context, the last time this ratio peaked was in November 2021, topping out at close to 193%. Just a couple of months later, stocks descended into a bear market that lasted nearly a year. Warren Buffett himself once called the Buffett indicator probably the best single measure of where valuations stand at any given moment. And today, that number is sitting at over 200%, meaning the market is worth twice as much as the entire US economy. For context, before the dot-com bubble burst in 2000, the ratio peaked around 150%. Even OpenAI CEO Sam Altman has called the current AI-fueled market frenzy a bubble. That's right, one of the key figures driving the AI boom thinks valuations are getting out of control. The S&P 500's top 10 companies, including Apple, Microsoft, and Nvidia, now make up more than 30% of the index's total value. This concentration risk means the market's performance depends heavily on just a handful of tech giants. If any of them stumble, the whole market shakes. According to data from Goldman Sachs and Morgan Stanley, this is one of the narrowest market leaderships in US history. Morgan Stanley's chief strategist Mike Wilson recently warned that the market is priced for perfection. which rarely lasts. Buffett's own history backs up this concern. Before the 2008 financial crisis, he was quietly sitting on a large cash pile. When stocks crashed, he swooped in and made major investments in companies like Goldman Sachs and General Electric at bargain prices. Then again in 2021, when valuations hit record highs, Buffett slowed his buying dramatically right before the 2022 bear market. So when Buffett starts selling and hoarding cash, it's not because he's predicting the exact timing of a crash, it's because, as he said many times, the market is there to serve you, not instruct you. When prices get silly, he waits for sanity to return. In short, Buffett thinks the market is overheated. And if history is any guide, overheated markets don't stay that way forever. Number 2, America's debt problem is spiraling out of control. Buffett's second major concern isn't about the stock market itself, it's about the US government's balance sheet. At the 2024 Berkshire Hathaway shareholder meeting, he put it bluntly, runaway fiscal policy is what scares him most about the US economy.
Very substantial inflation in the United States, but it's never been runaway yet. And that's not something that you want to try and experiment with because it feeds on itself.
Warren Buffett believed the United States has an unsustainable level of debt. Let's look at the numbers. According to the US Treasury Department, America's national debt has surpassed $37 trillion. That's more than the country's entire GDP. In other words, the United States now owes more than it produces in a year. History shows that when debt levels get this high, governments often resort to printing money to pay their bills. And printing money, as Buffett knows, leads to inflation, which eats away at the value of people's savings and undermines trust in the currency. In the 2011 letter to shareholders, Buffett warned that high inflation acts as a massive tax on savers and investors. He saw it firsthand in the 1970s when inflation soared into double digits and wiped out real returns for years. And while inflation today has cooled from its 2022 peak, it's still hovering around 2.7%, according to the US Bureau of Labor Statistics, higher than the Federal Reserve's 2% target. That might sound small, but over time, even moderate inflation quietly erodes wealth. Buffett is also watching what the government is doing with all that borrowed money. A lot of it is going toward entitlement programs, defense spending, and interest payments, not necessarily towards investment that grows the economy. According to Congressional Budget Office, the US is projected to spend more on interest payments alone than on national defense by the end of the decade. For Buffett, that's a red flag. As he's put it, you can't run deficits forever without changing the value of your currency. His fear isn't that America will default on its debt, it's that the dollar will lose its purchasing power. If that happens, investors around the world could start losing faith in the dollar's dominance, pushing up interest rates and driving volatility in global markets. So when Buffett warns about fiscal irresponsibility, he's not just making a political point, he's pointing to a real, long-term economic risk that could reshape how global investors view US assets. And 3, he can't find good deals, so he's waiting. Buffett's third reason is simple but crucial. There aren't many good investment opportunities right now. As a value investor, he's built his career on buying quality companies at fair prices. When those prices don't make sense, he'd rather hold cash than overpay. This approach might seem boring, but it's also what's made him the most successful investor in history. In his 1986 shareholder letter, he famously wrote, "The stock market is designed to transfer money from the active to the patient. Today, being patient seems like the best move. With stocks near record highs, bond yields still volatile, and geopolitical risks rising, Buffett doesn't see the kind of bargains that justify putting billions to work. Instead, he's been selectively buying into sectors that hold up during inflationary times, companies with real, tangible assets. Recent filings show that Berkshire Hathaway has increased its stakes in D.R. Horton, a major US home builder, Lamar Advertising, a company that owns physical billboards and land, and Nucor, one of America's largest steel producers. These companies have a few things in common. They generate strong cash flows, own valuable real assets, and are trading at reasonable valuations, all characteristics that perform well in uncertain or inflationary environments. Buffett's strategy here is defensive. It's about preserving capital until the market offers better opportunities. As he said countless times, be fearful when others are greedy, and greedy when others are fearful. Right now, he sees too much greed. To understand why Buffett's caution matters, you need to look at his track record. In 2007, Buffett was sitting on tens of billions in cash just before the global financial crisis hit. When markets collapsed, he invested heavily, buying into companies like Goldman Sachs and General Electric when prices were at their lowest. In 2021, as markets reached record highs and meme stock mania took over, Buffett was again stockpiling cash. The following year, markets fell more than 20%. Now, in 2025, he's doing it again, holding more cash than ever before. He's made it clear that this isn't about predicting the exact timing of a crash, it's about discipline. Buffett doesn't chase momentum, he waits for opportunity. As he once told CNBC, "We have no idea what the market will do tomorrow or next month, but we know that markets will go up and down, and when they go down, we'll be ready." In other words, Buffett's massive cash pile isn't a sign of panic, it's a sign of preparation. So, should we be worried too? Not necessarily, but we should pay attention. Buffett's strategy doesn't mean he's predicting a specific crash or recession, it means he sees more risk than reward in the current environment. When markets are this inflated and government debt is this high, he'd rather keep his powder dry. Financial analysts largely agree. According to JP Morgan Chase, global equity valuations are stretched relative to historical averages, and the Federal Reserve's next moves on interest rates could introduce volatility later this year. Meanwhile, the International Monetary Fund has warned that excessive debt has speculative bubbles, particularly in AI-related tech stocks, pose real threats to global stability. In a way, Buffett's caution is a reality check. It's a reminder that even in times of innovation and optimism, fundamentals still matter. Valuations matter, debt levels matter, patience matters. Warren Buffett doesn't panic easily, but when he starts hoarding cash, investors around the world take notice. His caution today is rooted in three credible and historically proven concerns. 1, the stock market is dangerously overvalued. 2, America's debt and fiscal policy are unsustainable. And 3, there simply aren't many good deals right now. If you found this video helpful, don't forget to like, comment and subscribe for more content like this.